Okay, so I've kind of told them a little bit about what you're going to be talking about, but I'm going to let you introduce yourself. I know you may need to take a breath after all that, especially with the fire marshal coming over and all that kind of good stuff. But woosah.
Yep. So my name is Reggie Graham. I'm with Thrive Mortgage. I'm here in Peachtree City. Actually, I've been doing this for 27 years, not on Facebook, evidently, but doing it in person, on paper, through email and everything else. So I'm having our thing was a conversation with Kizzy today to talk about the market, the programs that are out there, whether you're a home buyer, whether you're a homeowner, you're looking to buy your first home or your 50th home or whatever. So I just wanted to be here to be a sounding board for Kizzy and anyone else out there to answer any questions, and maybe we'll learn something too. So
yes, well, thank you so much for jumping on and taking the time out to talk to me. You and I have worked together in the past. We have done great deals together, no issues whatsoever. When you say that you can do it, you can get it done. We close on time, and I appreciate that, and I appreciate your business over the years. And so I want us to talk more about some of the programs, because now you're at a new place and you're having programs that you didn't have on some of the other deals that I had. And so I want you to just kind of tell us a little bit about those deals.
Exactly. I did move to a new place it'll be almost a year ago, but I made a move just because of the market change. Everybody sees what's going on in the market. And in Atlanta, Georgia, period, and my clientele, they do a lot of different things. So everybody's not going to fit into the traditional conventional loan, FHA loan, VA loan, or USDA loans. We do all that stuff. So, all those four top things, those are your normal loans. We do those, but I specialize in a lot of self-employed borrowers, and then different down payment assistance programs. But we have self-employed programs. I know you've heard of the 24-month bank statements, the 12-month bank statements. We have, so you can use personal or business bank statements. We allow a combination of personal and business bank statements, because you may have a job and you have a business, so you can use both of those incomes. We also allow where maybe one of the spouses or one of the borrowers are self-employed and the other person is a W-2 employee. We do that, but we also have VOE only loans. So what VOE only loans are, verification of employment. So we'll verify your employment. We won't ask for any tax returns or anything like that. They'll verify the W-2s or the 1099s only. So if you go off your 1099 income, say Kizzy's making $500,000 a year. She got a 1099 for Keller Williams. I will take that. She can get a CPA letter and say, hey, my $500,000, only 20% goes to my expenses, and they will use that 20% of 500,000 as her income. Of course, that's not a 3% down program or anything like that. That's going to be a minimum of a 10% down program. But most people, let's be honest, who are rolling like that, you know what I'm saying, they have that. Right. So we have 3-month bank statement programs, 4-month bank statement programs. And then the reason why the 1099 and VOE only programs came into play is because a lot of times we have stuff on the bank statements that we don't want to see, the underwriter to see. Right. So that way they don't ask questions, because once an underwriter sees something, what people don't realize, they can't unsee something. One of the advantages that I have here, not only in-house, is that I have a lot of correspondent lenders. So like, just say something did happen and Kizzy did send me a bank statement that we shouldn't have seen, I can send it to another lender and then we can do that. But we have those programs. We have new construction programs. A lot of people now, everybody knows there's a lack of inventory, so it's less inventory. So a lot of people are actually looking to build their own home again, kind of going back to the 80s and the 90s, like, hey, I'm going to build my own home. We do FHA construction loans, VA construction loans, and USDA construction loans. And then on VA, we have a one-time, coming up in July, we have a one-time VA closed loan. They do ask the veteran to put down a deposit, for this stuff, because we know how their appraised values change, but they can put down as little as 3% or 5%, not make a payment until the home is done, still use their VA benefits. And actually, if the house appraises more, your loan to value be less and your interest rate may be less. We still offer the 2-time close, lot loans, and all that stuff. So a lot of people are buying lot loans. buying lots and then working on their plans. So if you don't know what you want to build on your dream home, but you know where your dream home wants to be, then you can get that lot. You can still do that. The agent can still help you with that. And if you start building on the home, then any equity that you have in that lot, say you bought that lot for 50 and you held on to it for a year, now it's worth 150, you can use that $100,000 towards your down payment.
Oh, wow. Oh, wow. Okay. Well, you have a lot of programs.
Yes, we have a lot of programs, and we still have our traditional renovation programs, our rehab programs. So we have your FHA, 203K, we have your Fannie Mae home style. Then we also do fix and flip loans. So if you have a property, if you're an investor and you want to do fix and flip, give us a call. We can get you set up on that. We also do many commercial loans, up to 8 units for some of my people. So like if you're trying to buy a little, apartment complex, we can do that. And you can also do that as a DCSR. What is that? Is the debt service coverage ratio loan. So it basically goes on not any of your personal income. So if you look at that property and that property is going to bring in $5,000 a month in rent, and your mortgage on is going to be $2,500, as long as your mortgage covers the payment, you don't have to use any of you have to come up with your own down payment. And sometimes that can be a gift and you close in an LLC also. So as long as those projected mortgages, not what you write on the lease, but what the appraiser comes up with the average rents for the area is going to cover it, then you don't have to show any of your personal income.
What's the lowest down payment for that program? Because I've used that program a couple of times. Is it the 20%, the lowest?
No, we actually I have an investor. If you have a 720, they'll let you put down as little as 10%.
Really?
Yeah. There's one investor, but most of them want 15 to 20% down, like you said.
Okay.
But then the other thing is some of the ones that do 15 to 20% down, it can be gift funds. So they know that like a lot of people are doing this for their kids, or they're doing it like their kids go off to college, or they're just doing it for a second home. Instead of showing that income where you have a nice home, but you couldn't afford a second home, but you're going to Airbnb that home or anything like that. They know all that's going on. So all they're saying is, hey, we want to make sure the rents cover it in case that Kizzy can't pay this on her own. She could rent it out and then it'll pay for itself.
Right. Okay, so let's talk about a traditional loan, because I know we have some people on here that may be first-time home buyers.
Exactly.
Let's just say they got a job, they get a W-2, they file taxes, and they probably first-time home buyer. So we would probably use what program?
I would probably use, if they're first-time home buyers, most of the time it's going to be FHA, or you can do conventional loans. Conventional, you hear everything that says it starts at a 620. It's hard to get approved for a conventional loan at a 620, unless you're putting down 10% or something like that. Usually on a conventional loan, you want to be around a 660 if you want to get, a good rate, because you can get approved. And what people don't realize, the rate is good, but you have mortgage insurance, you have monthly mortgage insurance. So that mortgage insurance could go from $150 a month on somebody with a 700 score on conventional to $350 a month, to somebody with a 620 score. So it's really not the rate, it's the mortgage insurance. So the bank gives you a rate. You might have close to the same rate, but your mortgage insurance premiums may be different.
Now, I have never heard that. You're telling me something new right now.
Yeah.
I didn't know that mortgage insurance was what was going to be higher based on your credit score. Yep. I didn't realize that.
On conventional loans, it is. So on FHA, the benefit is it just goes off the loan amount. It doesn't go on your credit. So a lot of people who like, I want to go conventional. I got a 640 score. Yes, you can go conventional, but then you won't be able to afford it because FHA, the mortgage insurance premium is fixed because of the loan type and it goes by the loan amount. Conventional, they look at everything from if it's 1 or 2 people. You have MI companies that tell you they like 2 borrowers. Then you have loan level pricing, which is called LLPs. And if you guys look that up, if you just Google it, you'll see they're actually trying to charge people who maybe have better credit a higher, more fees so they can have more first-time home buyers, come into the market. So you may have anywhere from 1/10 of a point to 1/4 of a point added to your closing costs just because you're doing a conventional, loan.
Brianna asked a question, can you be a first-time home buyer but your spouse is not? So explain really what that first-time home buyer really means.
A first-time home buyer is anyone that hasn't owned a home in the last 3 years. And what we mean by own a home in the last 3 years is you haven't filed for a home, you hadn't filed any mortgage interest on your personal taxes or business taxes in the last 3 years where you're the individual owner. If your mom adds you to her title just because she, because they didn't do anything, they just wanted to add you to the title, that can disqualify you from being a first-time home buyer and get on certain programs. So like Georgia Dream, that would disqualify you. Even USDA, that would disqualify you. Chenoa doesn't disqualify you. Chenoa doesn't care if you're a first-time home buyer, as long as it's going to be your primary residence. You could have just sold that home the day before and closed on the new home tomorrow, and you can use Chenoa. So that's why you have different programs.
And on that note, like FHA, a lot of people as first-time home buyers go through FHA and they say that's a first-time home buyer program. But you can have as many FHAs as possible as long as you get out of one to go into another, right?
Yes. Yes, you can. So only time, and then FHA will give you certain exceptions. If you're single and you bought your house and you've been in that house and now you got married and y'all have 2 or 3 kids, and the only loan you qualify for as a lender, I can pre-underwrite your loan and submit it to FHA and get an exception. But it's going to usually be, they want to know what happened. Like, did you get married? So when we ask you that, we need proof. You got married, you got kids, and because you may not qualify for a conventional loan, but you want to keep that other home and you may have rented it out. Because a lot of times people got that FHA loan and the family grew, so they just start renting their house.
Right.
So you could there are exceptions where you can have 2 FHA loans, but it's not going to be like I got one on this street that I moved 5 miles, 5 miles down the road. It's going to be some of the things that count an exception are you have to have 25% equity in that house that you're leaving,
Okay.
and be moving a certain distance and meet those other qualifications.
Okay. Okay. And so, but let's say again, I'm going to stick with first-time home buyers again. People always like, what are the programs out there for first-time home buyers? What is a program for a first-time home buyer?
Honestly, the program for a first-time home buyer, as a lender, I'm going to say what you qualify for. So first thing I'm going to do is when I do the pre-qualification, if you call, you go on the app, or whether you call me on the phone. So if I talk to you on the phone, I'm like, everybody says that. So like what's special about you is going to kind of pick what program you are. If you're a veteran, oh, that's easy. We're going to go VA. You should go VA. Some veterans don't want to go VA. They don't want to use their VA yet. So then I'm like, what are you looking for in a first-time home buyer program? Are you looking for a lower interest rate? Are you looking for down payment assistance or closing cost assistance? Those are the only, really, the down payment assistance and closing cost assistance are only reasons that people ask about first-time home buyer programs. Right. So the thing about it is, if you go by counties, certain counties have their own programs. A lot of the small cities have their own programs. I know the city of Riverdale has one. Clayton County has one. Spalding County has one. All the cities, if you actually talk to someone at your city, they have something that'll give you $5,000 minimum up to 3.5% of your closing costs. And a lot of times those can be used with any bank. You go in, you do a separate application. The city actually gives you a check, or some representative will bring a check to closing. Georgia Dream is one of the statewide ones, since we're all in Georgia. Alabama Step Up is in Alabama. Texas has a lot. Every state has a Department of Community Affairs, and they have a statewide DPA program. And what it is, it goes off the MSI, basically the middle income. So it's not, those programs aren't for people like Kizzy that are balling out. They're for us average people who make, money, and it goes by your family size. So you could, like in Georgia now, I think you can, Georgia Dream in the metro Atlanta areas, you can be up to 90,000 and get down payment assistance on Georgia Dream.
Okay.
Georgia Dream is going to give you a lower rate. It's going to, right now, that rate is 6%. And that's for anybody, whether you got a 640 or 840, you're all going to get 6%.
Okay. Okay. Melvin, you asked something. I'm not understanding exactly what you're asking me. You say, let me know if you have any questions. Repeat whatever you're asking me. Brianna said, okay, my husband owned the home prior to us getting married. I've never owned a home or been on a title. Let's see, he is going to sell his home and we'll be buying a home together. Would that disqualify me as a first-time home buyer because I'm purchasing with him?
No, it wouldn't. Because they would go, because their income, if they're both, two people are working, I'm not trying to be funny, if they have a decent job, they're probably, unless they got a lot of kids, they're probably going to be more Chenoa versus if they need down payment, assistance, they're probably going to be more a Chenoa borrower. Chenoa does not have any income limits nationwide.
And yeah, and let's talk about Chenoa. Chenoa is 100% financing. That's pretty much.
It's 96.5% financing. So, but they give you up to 5%. So you have multiple programs on Chenoa. So say your 96, your normal FHA loan is 96.5%. So you have a 3.5% down payment. Chenoa gives you 5%, up to 5%. So Chenoa has its own fee. So basically gives you your 3.5% and their fee, it covers their fee of like 1.5%. Okay. So basically, but what it is, it goes up to the FHA limit for your area. So we know now in Georgia, like the FHA loan limit is like 590 or something like that, 550. Chenoa will go up to that loan limit and give you 5% of the sales price for your down payment. So it's not like where Georgia Dream is at 10,000 now, even up and 12.5. Chenoa goes up to 5% of your sales price.
Okay.
And so,
okay.
And you have a repayable option and a non-repayable option. So like, so to go into that before you ask that, so the repayable option is like a grant. So that goes on income. So like if the non-repayable, so if this is, hey, you're a lower income person or you're, under certain area or your family size is over something, then you can do that as repayable. That's only good, like, a lot of times we have builders and like, oh, I'm going to pay everything. And I do Chenoa, we'll do that one because they charge discount points on that one, but the person never has to make that payment. On the repayable one, then they have a payment, but after they make 30 payments on time, they can apply and they can get rid of that second lien.
Okay. Okay. And if they sell before the lien is up, then they just have to repay it when they sell.
They repay the prorated part, what's left over.
Okay.
Yep.
Okay, I have a couple questions. So one of the questions she said is the USDA loans. Patrice is asking, what about USDA loans? So can you explain USDA loans for me? And then the next question will be about working, what about one working and one on disability?
Okay.
So
USDA loans are great. So if you can qualify for a USDA loan, I would do that. It has a lower upfront funding fee than FHA. So only it's better than conventional because you're going to get, because you have that is 100% financing. And Kizzy was talking about 100% financing. That is 100% financing. Actually, it can go up to 102% financing, because if the house appraises, you can roll up to 2% of the closing costs on a USDA loan into it. And if it appraises over, there's other options that you can do. So USDA, you can't own any other property. So like if you own a lot and there's no house on it, then they'll let you, do something. But if you own a lot and there's a trailer on it, then, they won't do it. USDA goes by the level. So it's kind of tricky. You may think it's a rural area, but that one part of that street, one side of that street may be USDA eligible, then the other side isn't. So a lot of times the agents are good at saying, hey, this is a USDA eligible property. But if you're not sure, you can get with us, so we can put it in. You can actually Google USDA eligibility map, and it'll tell you if that address is available. But it's great. And then you can even refinance with USDA and still keep that lower MI than there is FHA. FHA, and then if you did some conventional loans, and you don't have to worry about getting to 20% equity. You'll still have the MI up to 20%, but it's a lower monthly MI cost than FHA.
What about, I'm going to piggyback off that before we go into the one work and one disability. What's the credit score for USDA?
USDA average score is 640. Actually, I go down to 500 on USDA. It's going to be a manual underwrite. So when you hear the words manual underwrite, so we can go down to a 500 on USDA, but that's going to be somebody with they just don't use a lot of credit. You have a lot of people who they go buy their car in cash. They do this. It's not going to be somebody with a 500 and they're late on everything. It's going to be somebody with a 500 or 550 and they just don't use credit, or they had some past issues. They're going to have to verify their rent. They're going to have to write a letter, you know, if they had filed bankruptcy or something before or anything like that. So those are manual underwrites. So that's somebody like looking at it, looking at your story, doing that. If you want to get an automated approval with USDA, you got to have at least a 620, preferably a 640. And the USDA does cut down your debt to income ratio because they don't want you, you know, balling out on it because it is a government endorsed program. So they usually have 41%. If you're somebody who has excellent credit and you're like over 7 and I run it and it's at 48% and then the computer takes it, they'll let you do it.
Okay. She has a follow-up question. If you own a property, USAID question, if you own a property, is it a time limit for owning or selling? Time limit? Well, I don't understand the question, Patrice. What do you mean by time limit on that one? But while we're waiting on her to text hers in, the question about if one person is working and one person is on disability.
Disability is income. So any income is income, whether you have an annuity, disability. The only thing that we cannot use as income is like workers' comp. So a lot of people get the workers' comp and disability confused. Disability actually comes from the Social Security, you know, the Social Security, and we can verify that you're going to receive it for at least another 3 years after you close. Same thing with alimony or child support. We have to verify that you will be the recipient of that at least 3 years after you close. And then we would specifically mean 3 years and a day. So like if your kid's so basically anybody whose kid is 15, you can't use child support for income.
Gotcha. Okay. She still hasn't added in hers. So for FHA, what's the basic credit score right now?
FHA, for FHA without a lot of overlays, 580. And then on FHA, we also go down to 550. You can put down 550. You can put down 5% or 10%. And then we have FHA loans that they also go down to 500. It's going to be the same thing like on the USDA, a manual underwrite, verify your rental history. You got to have some reserves saved up. They want to see like, you know, so after you close, what reserves are. I put down 3.5%, and I still have 2 months of my mortgage payment left over in the bank after I get my keys that day, you know, when I close. Because the first payment that most people miss is the first payment. Because they went to go move, they went to go buy a new car, they went to go buy furniture, and like, oh, I got a mortgage payment, you know. So that's why they would like to see the reserves.
Gotcha. Okay, so her question is, I think what she was asking, because how we say FHA, you can't have 2 of them.
Mm-hmm.
You know, she said, is USDA the same? Is there a time limit? Like you have to sell one to be able to get another one?
Yeah, you could sell your USDA. You can only have one USDA loan. So they're like, they don't really give any exceptions on that. So you could just sell your house. You could sell your house in Atlanta and then move out to a rural area. As long as you don't own that house at the time of closing or it closes before you actually close on your home, you're good. There's no time limit though.
Okay. Shayla, you asked, so could my husband and I apply for FHA or USDA? You can apply for FHA with no question. USDA is specialized to area.
Yep. So usually what we would do when somebody applies and they say they want a USDA loan, and I'm like, are you just going to shop in the area that's for USDA? So then we can run it and we'll run it through the system and we'll let them know how much they qualify for USDA. But then just in case you go across the street and that house is FHA approval, you know, FHA, you know, then that house isn't USDA eligible, then FHA would be your backup. So you could apply. Anytime you apply with me, I would tell me what type of loan you want to get. I mean, not that you're going to get that, but I wouldn't know what that kind of gives me a direction, what you're looking for. And then I will call you and say, hey, Kizzy, you don't really qualify for USDA. I said, you'll qualify for FHA, or you don't qualify for USDA at that amount. You will qualify for FHA at that amount. So that's the thing with your pre-approval letters too. And Kizzy can tell you that when they write the contract, they got to tell the seller what kind of offer I'm doing. Am I doing USDA? Am I doing FHA? Am I doing conventional? Because each product, the appraisals are different. The underwriters are going to accept different stuff. USDA, using the USDA area, we're going to want a well test, especially if the house is vacant, if it's on septic and all that. Then a lot of times you could take stuff from the county. If it's a new home, the builder's already done all that, so you don't have to worry about it. Or if you have a great homeowner that you're buying it from, they probably have a contract, like you have a home warranty. They have somebody that comes out and checks their septic and their water and all that all the time. So people don't realize a lot of the big mansions that are sitting by themselves, they're on septic, and they provide a septic letter.
Right.
So you can apply for anything, but if you find something, your lender most likely, we can easily pivot. It's the same documentation that you have. Now, the only issue I'll bring up on USDA, where FHA and VA, we can do, if you're a W-2 employee, we don't need tax returns. If you go USDA, they do want to see your last 3 years tax returns. So if you got something squirrely on your tax returns, you got something, well, because if you got something squirrely on your tax returns, they'll go off the last year. So if you said, I'm a beautician on the side and I lose $50,000 a year, but in 2020, that was in 2020 and 21. And then in 2022, I dissolved my business and you file taxes and you don't show that extra income or loss on there, then you're fine. But they do require tax returns for USDA, even if you're not self-employed.
Okay.
FHA and VA, FHA and VA don't straight up without a DPA don't require tax returns. Georgia Dream requires tax returns for 3 years. Chenoa does not require tax returns unless you're self-employed. So, and if you accidentally submit them, we don't need them. So.
But one of the best programs that I think is so underutilized in society now is VAs. I think veterans are not taking advantage of the fact that they can purchase a home and not have to put a down payment on there.
Yes. And VA loans are easier to get approved than even FHA loans because they're more liberal on veterans, where people don't realize on FHA loans, if you have collections and student loans and stuff like that, if your loan says you're deferred and it's going to be deferred for 12 months on VA, then we don't count it in your ratios. If you just have a deferred student loan that says 0 on FHA and conventional, and it's not in the IBR, you have to count 0.5% of the outstanding balance against your DTI. So that's why a lot of people are like, I don't have anything but my car note and a couple of credit cards, but you have $300,000 worth of student loans out there. I have to count $1,050 a month, $1,500 a month against your DTI. But unless you, yeah.
But that's changed because it used to be 1%.
It used to be worse. If it was 300,000, it'd be 3,000 a month.
Exactly.
So now it's better. But the best thing to do is a lot of people are like, well, I'm going to get it forgiven. I've had 3 calls today like, well, I work at this place and they're going to forgive it because I'm in the medical field. They're going to forgive it because I'm teaching at this school. But until they do, it's not forgiven. So, and actually, I can't tell you to do this, but the best thing to do is to put it in an IBR, because you could have $300,000 worth of student loans. And a lot of the agents that work with me will tell you, I'll say, go call and see what your IBR payment will be. As long as it's not 0, if it's $100 a month, and a lot of times it'll be about $150 a month for $250,000 worth of student loans, that's a lot better than me counting $150 a month towards your debt to income ratio than counting 1,000 or something.
Right, but I got to stop you because you're using a lot of
terms. I'm sorry.
People are not going to know. So IBR, what is an IBR?
Income-based repayment plan.
There you go. I need you to break it down.
Income-based repayment plan. And 0 is not the thing to get. If you're trying to buy a home, 0 is not the number. If they tell you, oh, you don't have to pay anything, say, what's the least I can pay that's not 0? And accept that payment. You send a letter to me or your loan officer or your processor and say, hey, I know y'all told me I could only afford $200 because I had those student loans and y'all count $1,000 a month against my payment. I just got into an IBR and I'm paying $125. So then guess what you gave yourself? You gave yourself $875 more a month to spend on a mortgage.
Right. Can you purchase a multi-dwelling unit with a VA loan?
You can, and they're gonna look at it. You can. There's certain exceptions for that, because in some places, if that's what it is, a lot of underwriters look at it differently. But I mean, I've only seen that. I've been doing this 27 years. I've only seen it twice. You can with an FHA and still put down up to 4 units and put down just 3.5%. So that's what most people do.
Which is some that people can do. Those are mortgage hacks. Like
Yeah.
your first home, let it be a multi unit with a duplex or four, and so you stay in one, and then rent it out, and so you're able to have a rental property along with having your personal property all at the same time at a 3% or 3.5%.
Yeah, down payment. And the other part about it is you can use, if you buy quad and you do 3.5% down or you do 5% down, then you can use the expected rent toward your affordability. So maybe you couldn't afford a $400,000 quadruplex, but you're going to rent out the other 3 units, and they say you should be able to get a minimum of $1,500 a unit. So then you have another $4,500 you're adding to your qualification income.
I like that. I like that. I didn't realize that one.
Yeah.
So you can add that rental in. So okay.
Yep, you can add that rental in.
It's just twirling over here. There's different ideas. Okay, cool. So again, like I said, most people use conventional VA or FHA. But when I send people to you, you talk to them, you get all their information, and truly you go through any other programs to see what best fits them, correct? Because a lot of people don't know these programs.
Correct.
They don't know what's up.
Yeah.
And, you guys are the ones who's like, okay, so based on your income, based on your credit score, based on how much money you got in the bank, these are what benefit you, because you want to offer as much to them as possible.
Yes. So we don't, and the thing about it is that people don't realize in the bank, well, for us, we get paid off loan amounts. So we tell you, you want 500,000, I tell you can only afford 385. I'm not doing that because I don't want to do it. It benefits everybody because in the real estate and mortgage industry, you're commissioned off loan amounts. We're telling you this because that is the most that you can approve for. The worst thing to do is, and I suggest everybody to get pre-qualified before they go, doing something, because pre-approved, not pre-qualified. We'll talk about the difference between that. You get pre-approved and you go look at $400,000 homes and you can only afford 300,000. Kizzy, is there a big difference between a 400,000 and a $300,000 home? So it's going to be hard for Kizzy to sell you on what you can afford if you've been riding around for 2 months looking at $400,000 and $450,000 homes when you can only afford 300,000. And you want to say only afford, as that's what you can afford. So you want to take the word only out of that, but that's what people feel like. They feel deflated, but at least you're able to purchase a home. People don't realize 48% of the people who apply for a home mortgage their first time are denied. Are denied. So 58% of the people that get a mortgage had to go through some type of credit counseling or anything like that. So you want to know what it is, and what we specialize in is, say something can't be done or you got to work on something, we're going to not just tell you what you can afford, but hey, if you want to afford more, or these are some solutions, or if you want to look at this, or if you want to try to get a better rate. In this market, rate is just a conversation, because people think like, hey, I have a higher credit score and all that, but you're looking at, and usually what I'd send people is we'll send you a TAC, a total cost analysis. So like if Kizzy qualifies for FHA, conventional, and USDA, I'm going to send you a sheet. You can look at it all the time. If say it's Patricia, and Patricia, Kizzy's her agent, I'm going to have Kizzy link to it so y'all can both see these are the differences, and these are, even if it's the same program and it's different rates, so you can see a lot of times it's not that big a difference between the rate, between the rates and the payment as you think. Especially because it goes on loan amount. Now, if you got $1 million loan, yes, a point is a lot. But if you're looking at a $300,000, $250,000 loan, a half a point, a quarter of a point isn't that much. So that's what you want to look at. You want to look at that final number. You don't want to get caught up in the rate, because what you look at, why you care about the rate is because you care about the payment.
Right. Again, and that's what we have to use the example. When we go buy a car, we don't look at the rate. We look at how much we pay a month.
Yeah.
And that's how we need to look at when it comes to the house. Don't pay attention to the rate. As long as we can afford the mortgage, the rate part doesn't matter, because we don't care when it comes to credit cards.
We don't care when it comes to cars.
We don't care so much on the house. We so stuck on interest rates, but we go buy other stuff all day long and don't look at interest rates on it.
True. And then you want to attach a payment to, and what I tell people do is you have this payment. You're really more approved for a payment. You're not approved for a purchase price, because we can only, so when we say this is how much you can afford, so if I say you can afford 300,000, that's because you can afford a loan of 300,000 or whatever. Then if you have an uncle or a parent that wants to give you extra 20 or 30,000, you can go do that. But even with that, you want to talk to your lender, because maybe it's some debts they could pay toward those debts, and that could make you afford more. So it's not always throwing cash at the down payment. I could be like, you got this car note you got $900 a month on, and y'all only owe so much on it. Go pay that off, and then that's going to give you another $100,000 that you can afford. So those are things we look at too.
That's why I like to send clients to lenders, even if they say, I'm trying to pay some stuff off first, or I'm trying to get it together first. No, let's talk to a lender. Even if you're not ready at this exact date, at least they can look at it and tell you, instead of you paying this down, go do this. Because people don't know. They just think they need to pay it down, or they need to pay it off, or they need to go back and pay some old credit or whatever.
No.
And it's not affecting you, and you can still go ahead and buy this house, and you can use that as a down payment and a closing cost.
Yeah.
So, but I think.
And then the piggyback off what Kizzy's saying, I have the cheat code to it. So when I pull your credit, I pull another report called the Wayfinder report. Yeah, it costs me $5 or whatever, but it's a cheat code for you and I, because instead of you thinking, oh, I got to go pay this bill, there's some bills on your credit report that don't have to be paid. If you pay them, it's actually going to hurt you and drop your score. I send you something that tells you the top 3 or 4 payment bills that you need to pay and exactly what balance they are to increase your credit score. Because you may get approved for FHA with your current credit score, but you're like, Reggie, I got enough money for closing costs, but I need down payment. Then I was like, hey, you got to get your score up 20 more points. I send you a report that says pay this down, this down, this down. It tells you exactly what balance to pay it to. And then you just call me back. You send me proof that you've done it. I update it with the bureau, and then we do it. And even people are working on this stuff now. We have the ability to do soft pulls. So if you're like, oh, Kizzy sent me to this person, Reggie, now she wants me to look at you, and I paid this stuff off, but I don't know who made it a difference. Guess what? I can do a soft pull now, and then we can see if your credit score has gone up. And then we'll be able, and then if it has, then you can go ahead and complete the full application. But on the soft pull, you don't get that credit inquiry. So that's something that we're doing new. Within the next few months, we'll actually be able to run automated underwriting, desktop underwriter, and loan prospector on soft pulls to let people know if they can actually get approved, and then they complete the full application. So if you need somebody, if you're working on your credit, because when you look at the credit stuff, like, don't trust Credit Karma. I know somebody probably jump on me, but anything that's free is usually worth crap. So you want to use the bigger stuff, the Experian, the Equifax, and stuff that'll tell you your other scores. And they have credit, and they have credit analyzers within it too that'll tell you that. But what Kizzy's telling you is, like, don't pay off some of that stuff. It doesn't make a difference. Medical bills, we don't really have to count. So like, unless it's like something recent or whatever, VA, they get to ignore a lot of stuff. So especially if you're a veteran, talk to us first before you start paying off stuff. And then some things you can pay, or you can just, we'll count a certain percentage in it. And if you're not trying to max out your approval, we can just count 5% of that outstanding balance into your DTI, and you don't pay them, you deal with them later. So those are the options that we give you. It's not so much to get you, we want to tell you what's the easiest way to get approved. You don't have to have an 800, 700 credit score to get a loan. There's some programs that require 700 score, but if you're a first-time home buyer, that's not what's required to be able to get into a home.
Right, and people think they can't buy for another year or so, and it really could be a couple months. It's just certain things that they just need to know. I had something in my head. Oh, the credit score. So let's piggyback on that for a quick second. Credit Karma tells us what score, because it doesn't tell us the right score. It tells us the score that is not what you guys use. Correct. Right?
Yes, we use a full mortgage. Mortgage lenders have their own score. Car dealerships have their own score. Your credit card has your own score. So most people use a FICO 9 or a FICO 3. Like, you can go from, if you look at everybody, if you have a credit card, you should opt in to seeing what your scores are. Now, at your bank, the score that your bank gives you, if you're with a large bank, that score is probably going to be the one closest to what the score that we have. But like all those free things like that, even on Mint, I love Mint because it tells you all your stuff. That score is probably gonna be lower than your actual score. Credit Karma is gonna be 30 to 40 points higher, or it could be lower because they take different stuff into account. Mortgage credit reports, we take into account the account history, installment loans, and just the credit card history. So all of them do the same thing, but each of them takes stuff into different, weighs it different. So it's all the same stuff, but it weighs it different. But that's where the soft pull comes in. If somebody's like, I don't want anybody to pull my credit, I know what it is. I have people that come in, and now it used to be more like their score is going to be 20 points lower. I have people now, because there's so many different stuff, so many different ways you can monitor your credit. Like, oh, I'm only at a 620. I need this program. Like we were talking about USDA. She wanted to go USDA. She's in Alabama, and in her area, it's all USDA. I pull it. She goes, I don't think I'm at a 640 yet. I said, the only way to know is to find out. I pull it. She's at a 672. She starts crying on the phone. I was like, so what do I do now? Go buy a house. You know what I'm saying? Go buy a house. We got 120 days before we got to pull a new report. You know what I'm saying? So always, and then you want to, and like she was paying down stuff. She was going to do just what Kizzy said. I'm going to go pay this one down. They told me to do this. You told me to do that. And I'm like, let's just see where it is, because even the analyzers, they're only good for 30 days. So your credit is your reputation over time, but your score is a reputation of where you are that day. So, and people don't realize our credit reports are trending. So when I look at your credit report, Kizzy might be at a 700 right now, but then it looks like in the next month, it'll tell me if she's trending upward or downward. So they said that within the next 31 days, her score probably dropped to a 682. So with that, I look at it, because if I know Kizzy, like she just started the house hunting process, I know she's going to probably be looking for what, 60 days, Kizzy, 90 days maybe. So I'm going to send her Wayfinder and say, hey, I got you approved, but on this Wayfinder, I want you to start concentrate on these accounts. Pay everything as normal, but maybe you pay a little extra, you know what I'm saying, on these to make sure. So if we have to pull a new report or you get a new build, you know, we got to keep your credit score up for 6 or 8 months, that your credit score stays where it needs to be.
That's good information. That really is good information. I didn't realize that you guys had that ability to see what it's going to be in the next couple.
Yeah, it's trending. And even on the loan approvals, the automated loan approvals through Fannie Mae and LP is trending. So it kind of tells you, like, somebody, you may be trending upward or you may be trending downward. So if you're trending from a 740 towards a 640, you may not get an automated approval.
Okay.
You get what I'm saying? But if you're trending from a 640 to a 680, it may give you automated approval. And how we know that you're trending is that your credit card debt is getting higher and higher a month, but you know, so then you're trending downward. But if you're paying off your balances, you're paying extra payments, then the credit score, they see that you're trending upward. So there's like, hey, she has some extra cash. She's paying off her bills. She's not maxing out her credit cards every month or whatever. So people think if they max it out and they pay it off every month, that's good. Nah, you want to pay it before the due date or do extra payments. So
gotcha. Now I can talk this all day because this is just what I do. So, but I want to ask anybody that's on the call, is there any questions that you guys may want answered that we have not talked about right now? We got a little more time to answer questions, bring up things that maybe we hadn't brought up yet. So feel free to jump in and ask those questions, because if not, I'm just going to keep asking him questions until I get. So feel free. But I was going to talk about something else.
You're thinking about that. I want to let you guys know that through Thrive, we have a Thrive for Home program. And what that is that a lot of times, like what Kizzy and I are talking about, the terminology on the credit reports and everything. So I have a team that I have 2 ladies that go over the credit report with you. Like, I'm going to go over stuff with you, but like, if I say that Wayfinder report, we're going to kind of hold you accountable, because I've spent 30 minutes talking to you doing this and we're saying, hey, you're going to pay this down. So they're going to call you and go over the report, and they're going to say, hey, this is that, like whether you may have your report frozen or there's some type of block on your report or there's some discrepancy. So through our soft reports, or they'll teach you how to pull your own report so you'll get the actual scores. They'll go through it. And so you don't have to go out and pay for credit repair or pay for credit restoration or anything like that. if you have a hard case, some people's cases are harder. Like sometimes you can go to the urgent care, sometimes you got to have surgery. You know what I'm saying? So if you got to have surgery, then they can refer you to somebody that we work with, and they'll still report back to me and let us know. And the good thing about that is we're not pulling a report and you're getting those hard pulls. We have the ability to do a soft pull, and they'll say, hey, Mr. Smith is ready to get his credit pull. We got all the disputes off. That's another thing. Lenders don't want to see active disputes, you know, so all the disputes are closed. So we'll know the right time to pull the credit report and get you back in. But in the meantime, we still go through Latrice and I, my team, will get all your income documentation, let you know how much you can afford, because there's no reason to be not, there's some other things you might have to look at. So you might have spotty job history. FHA now, if you're a job hopper, excuse me, they want you, they want you to be on your current job for 6 months. So like if you had a job gap of 6 months or more, or you've just been, I went from self-employed to employed or whatever, that used to work. So, but if you were serial self-employed and now you're employed in something that didn't have anything to do with your self-employment, then they're going to want you to be on your job for 6 months.
Well, that's not bad though. It used to be what, 2 years?
2 years. But you had a lot of people now, like they were selling cars and now they're working at, you know, Comcast. So they're like, you're not in sales, you're not doing that. So we want you to be on your job for, you know, 6 months. But people, like if it's a student and they come out of college and you got a medical degree, you're a nurse, you don't have to be on your job for 6 months. You usually got to have a permanent job and be on your job for 30 days. As long as they tell you you're going to be scheduled so many hours, we can use that as your base income for a loan approval.
I love that. I found that out about a month ago on another live call, and I love that you can use your college career as your job. Like you can show
your job history. You show your transcripts, and like you haven't been working for 2 years. We put that, hey, you were at University of Georgia, you know, wherever, and then you show that, and your degree matches your job. You're good.
Okay. You know, I was talking to a client the other day, and she wanted a house, but she didn't want them to pull her credit. She's like, I just don't think I'm right, and I don't know. She's like, I just don't want to be denied. And I'm just like, but you won't know if you will be denied until, you know,
Yeah.
and what's worst that can happen? You're not going to die if you don't
True.
get it. But at least you will know where you are and what to do going forward, because we don't want you to be so afraid to have your credit pulled that you just don't do anything and you continue to rent forever.
Yeah.
So it's nothing to be.
Well, that's where the soft pulls come in too. Now, that's one of the reasons we wanted to get the soft pull ability, because we know that soft pull is going to be related to the score that we have, you know. So they're like, I don't want to get denied, I don't want to get this. You still need a consultation. What if you're sick and there's something worse, or what if you want to at least know what it is? Like, is this really strep, or do I just got sinus problems? You know what I'm saying? Or is this something else? What is this bump? Is this something serious, or is this just going to go away?
Or just to even know how much money you're going to need. You may not have any money up, but you need to talk to someone, figure out kind of what you may qualify for, so you'll know how much money you need to have saved up to do that. Because so many people just decide they want to buy at one time and they don't have any money, and then you can't because you just have yourself. So it's okay.
And you want to have a goal to shoot for. So like if you sit there and I say you can afford $300,000, but you don't have the down payment, or you're working on your credit, it's easier if you have a goal, if you have a tangible goal and you can see that, to work on that. If you don't know, then you're not going to take those steps. If we tell you these are the steps and that's what you can get, and you see a house or a neighborhood that you want, you're going to work towards it. And then we're not going to high pressure you, sales you, or something like, hey, you got approved for this. You got a contract? We're not going to call you every week ask if you got a contract. We'll check in with you, or if your file is going out of date, like, hey, can you send us some updated pay stubs, or did you file your taxes yet? It's a new year. We'll do that. We'll keep your file active as long as you want to be active. You know what I'm saying? But we want to at least tell you where you are and what you have to work on, so that you know where, like she said, you got to know where you are. And then you want to be realistic. You got to know, maybe I need to get another job, or maybe I can't buy by myself. I need to have my spouse on there. Those are the things you want. Or maybe I was worried about my spouse's credit. I have so many people, it's so funny. People call, my credit's good, but his is bad or hers is bad. And it's just the opposite because they're looking at one app and that app says one thing and they're doing it. Or I'm at a 700. He's probably at this. And I'm like, they're good. And like, even with his credit, I'm like, I was with a lady yesterday. I'm like, even with his credit isn't bad. He's at a 686. You just at a 702. You know what I'm saying? So if I get a 620, 640, I'm dancing the jig because I can do a lot. You know what I'm saying? So I don't need you to have a 700. And those people are like, oh, I'm at a 680. I want to be at a 720. You're not getting anything special being at a 720 unless you're doing one of those specialized programs like Kizzy was talking about earlier, the DCSR, or something like that, trying to put down 10%. But we do DCSR down to a 620, 640. So it's an investor. So kind of, the rate's going to be higher, but you're doing that as a rental property. So you're passing on the rent like your landlord's doing to you right now. You're passing on that cost to them. Exactly. So.
Okay, well, Reggie, I know we're going to talk one more thing before we get off tonight.
No problem.
Talk about the program that you have for real estate agent and for buyers so that we can put them in our system. And
yes. HomeBot. HomeBot is free for you guys, and it's going to tell you a lot, whether you're a homeowner now or you want to be a homeowner. If you can contact Kizzy or myself, and we'll get you set up. What HomeBot does is sends you a monthly report. I know there's Zillow and all that stuff out there, but what HomeBot does, it actually tells you if you're looking for a home, if you're pre-qualified, you put in the zip codes, it'll tell you from everything from how long it's probably going to take you to find a home in that price range in that zip code. If you've been pre-approved, I put in your pre-approval information, whether it's FHA or VA. If you own a home already, it gives you an equity report every month. And you can log in anytime you want to, so you don't have to wait so you to log in and it gives you like, hey, I have some people call me today, like I own this house. I don't know if I should do a cash out refi or if I should do a HELOC. It'll already kind of reach out to like my rates or your lender's rates and kind of tell you like, hey, this is how much you'll save if you do a HELOC versus a full cash out refi. You want to buy a new house. We had somebody on here saying, hey, I want to buy another home. It'll say, hey, you want to buy a $500,000 home. You own a $280,000 home that you bought for $200,000. It'll tell you, hey, if you take out $40,000 on this home on a HELOC and put that down as the down payment on your new home, this is what you'll look at. So it gives you a lot of those options. You basically can have HomeBuy and call me and Reggie, say, hey, this is what I want to do based on HomeBuy. This is what it is.
Okay.
You can also message Kizzy and I through HomeBuy. I want to get pre-qualified. You can request a CMA because HomeBuy will tell you, Zillow will tell you, but then through HomeBuy, if it's Kizzy, she's going to reach out and say, do a CMA on your house. If it's somebody else, I'm going to reach out to one of the agents I use and say, hey, Kizzy, hey, so-and-so, they want a CMA on their house. So it works for agents too to get clients. So Kizzy should go in and put in everybody she's already sold a house to in her career first, and then you want to put in all the people looking for a home because you can search through HomeBot, and it's not like Zillow where it's going to do that and it's going to capture your leads and all that. It's not going to send Kizzy's clients to someone else, and then it'll let Kizzy know that you're interested in that home, and it doesn't go out to like Open Door and all that other kind of stuff. So it kind of gives you realistic, like you check on that house, gives you a payment and all that. So it's very helpful. It gives you a lot of information, a lot of knowledges. Then every once in a while, when I'm not on Facebook, I'll record a video and I'll post it up there. You know what I'm saying, with any programs, and you get that. But you can have multiple properties also through HomeBot. So you investors, if you have 8 to 10 properties, you can put as many properties in there as you want to, and you have a report on each property.
Yeah, I think put my investment properties in there, at least one of them, so I can so I can see it and see how it works.
Yeah. Yep. And it doesn't tell you if you want an Airbnb. If you have that second home in Florida, Kizzy, and you say, we ain't there that much, and you want to put it on Airbnb, it'll even tell you, hey, I want to, if you, what times are best to Airbnb it and how much you should rent it out Airbnb. And if you do it 10 days a month, how much income you'll make off that house. Because guess what? If I'm Airbnb in the house, I want to pay for the house. You know what I'm saying? I want it to pay for itself. So you may use it part of the time. So it has that on there too.
Brianna came back. I don't know if she was on when we first started talking about this, but she asked you, can you tell her a little bit about how student loans affect the loan approval? So can you say that again about what the percentage is and what's the best way to do that?
Student loans affect you because now there are some people like if you're a veteran, if it's deferred for 12 months past the close date, then we don't count it. Student loans reduce the amount of home that you can qualify, the amount of loan you can qualify for. I won't say home because you can have a parent that gives you, you know, a big lump sum of money. So whatever your student loans are, if you have, let's take an easy number. If you have $200,000 worth of student loans and you say my payments are deferred, we still have to count 0.5% of that outstanding balance. That's $1,000 a month that I have to count against your debt to income ratio. So where you might have thought you could afford 300,000, and you already have a car note that's 500, and you have student loan payments, and your student loan payments were zero. They're actually 1,000 when you get approved for a mortgage because you have $2,000 of outstanding student loans. But if you get into the income-based repayment plan, even if you think you make a lot of money, and you don't pick zero, you take them out of deferment and say, I want to start an IBR. That IBR may not start immediately because you may still be in a deferment until July. As long as I have that letter says, hey, July 3rd, I'm going to start, she starts an IBR for $125 a month. I can count $125 a month against your debt to income ratio versus that $1,000. So it's better to do it. And after you do it, you gotta reapply every year. So the next year, if something happened or stuff got expensive, if you wanted to go back to zero, you could. But we prove it and we verify it with the letter. They send it to the credit bureau. The credit bureau says, hey, yeah, we got this letter. We verified the letter, and her IBR is $125 a month, and that's what the underwriter is going to count against your debt. They're not going to count the $1,000 a month on the $200,000 of student loans.
Okay. Okay, guys. She said thank you. She appreciated it. You're welcome.
You're welcome.
Thank you all for jumping on. I know some of you have already jumped off already, but thank you guys for jumping on. Thank you, Reggie, for coming on.
Sorry I was late.
Hey, you're okay.
I'll be better next time.
Got it now.
All right. But if you guys reach out to Kizzy if you want to get in contact with me, or my website is just reggiegrahamhomeloans.com. And then if you want some information, or if you want to get pre-qualified, or you just want to know, scenarios, we can talk scenarios. And then I can send you my Calendly link, or just email me and I'll call you and set up a time or whatever. Like I said, if you email Kizzy, I can get you set up with Kizzy. And so she'll see, if you need questions about your properties, what home buy. So we'll send you our home buy link to get signed up. So what it is, I'll get Kizzy and I have one together. I'll send it to her. She can post it to all her social media sites and you guys can sign up. And we'll be good to go.
Yes, let's do that. As soon as I get off, let's post that so that they will have it. So, okay. All right, guys, thank you very much for joining. Thank you, Reggie, again for jumping on with me, and we'll talk soon, okay?
All right, you guys have a good night.
Thanks. Bye.